Over the next few weeks, we'll begin to discuss the role of monetary and fiscal policy. That is, we'll take the theory that we've been working with and we'll try to show how it applies as various policymakers try to use macroeconomic theory and use the tools and institutions they have at their disposal in order to make policy and try to affect things like the long run rate of output and growth and to prevent business fluctuations and sort of all the things we've been talking about so far. So how does policy figure into that? And the plan here is that this week we'll talk about the sort of institutions and practices of monetary and fiscal policy. Next week we're going to look at some political economy issues and talk about the challenges that policymakers face when they try to make policy. And then the week after that, we'll look at how they actually try to implement, how policymakers actually try to implement that policy and see how successful they are. So this week we're going to look at sort of institutions and processes and sort of the tools that policymakers have. Here we'll talk about Chapter 15, which is monetary policy. There'll be a separate short video on fiscal policy. So for Chapter 15, right, the key institution when we talk about monetary policy, of course, is the Federal Reserve System. I'm not going to say too much here in the video. The book and the PowerPoint cover it pretty well, but the thing to remember, of course, that the Federal Reserve System is created by the U.S. federal government, was created by Congress. Technically, it's made up of 12 regional banks with a headquarters in Washington, and in Washington we have the main organizations that sort of run it. We have the Federal Open Market Committee, which decides sort of day-to-day policy, and the Federal Reserve Board of Governors, which sort of has the broader view. I'm not going to say too much more about the structure and so forth of the Fed. Again, as I said, it's in the book. What I really want to focus on, excuse me, in this video is some of the more tricky practice stuff, like what does the Fed actually do and how does it do it. So the first thing I think that to talk about to understand that is we need to understand the nature of what is called fractional reserve banking. Okay. When you deposit your money in the bank, and I think all of you know this, I'd be surprised if you didn't, but when you deposit your money in the bank, of course, it doesn't just sit there in a drawer with your name on it, sort of waiting for you to come get it. Banks take the money that you deposit and they lend it out to other customers. The question, of course, is how much can they afford to lend out and how much do they need to keep just in case you do come in and say, hey, I want some of my money, or you write a check or use your debit card and your bank has to take money out of your account and pay Kroger or pay someone else. So how do they make those decisions? In most countries around the world, that the percentage that banks have to hold in what we call reserves, that is, if you put $100 in the bank, how much must the bank keep in the bank? How much can it lend out? That number is generally, in most countries, regulated by the federal government or the central bank in some way. In the United States, roughly speaking, that number is about 10%. Other countries don't have that regulation. Canada, for example, what we call the reserve requirement is 0. Banks don't have to hold any reserves. Now, obviously, banks will want to hold some reserves, right, for the reasons we've just been talking about. There's a cost to them if they don't have enough reserves on hand. If they don't have enough reserves on hand and people start coming in asking for money or writing checks or using debit cards, banks don't have it and people can't get the money they need and banks have a problem. Right? We have what we call a liquidity crisis. Banks want to avoid that at all costs. Even in a world where a government didn't sort of have regulations about that, a bank's reputation would be on the line. So banks want to avoid holding too few reserves. All right, so why not hold why not hold lots of reserves, right? Well, obviously there's an opportunity cost to holding reserves. And this is the key to understanding banking. What banks do with your money, of course, is lend it out to other people and they charge those other people interest. Banks make money by the difference between the interest they earn on their loans and the interest they pay on their deposits. So the difference between what the bank earns by lending your money out to someone else and what it pays you, that's where banks' profits come from. If banks hold too many reserves and don't make a lot of loans, they can't earn that revenue, they can't make that profit. So one of the tricks for banks is not to hold too many reserves and sacrifice to get the opportunity cost there is the interest they would earn on lending that out. So banks have to sort of balance out this liquidity risk of holding too few reserves and the opportunity cost of foregone interest revenue by holding too many. So banks try to figure that out. We call the percentage that banks either have to hold or desire to hold, we call that the reserve ratio. And we call the amount of reserves that they then are required or desire to hold, the actual amount, right, is required or desired reserves. But we also can talk about, when we think about banks, we can think about their total reserves. That is, what's the total amount of reserves they have on hand at any time, right? And for commercial banks in the United States, that's the sum of the cash they keep in their vaults, the dollar bills and the coins and so on, plus the deposits they have at the Fed. So those are the reserves that banks have at any given time. That's their total. Some percentage of that is their required reserves, and the difference between their required reserves and their total reserves is what we call their excess reserves. And for banks, the key number is that excess reserve number. That's the number banks really want to focus on. They can't lend out more than their excess reserves. If they do, they run the liquidity risk, as we've talked about before, or if it's the law that they can't, then they face that problem. Holding more excess reserves, holding too many excess reserves, we said, has an opportunity cost in terms of the interest foregone. So banks want to pay attention to their excess reserves. The other thing we need to understand is that when banks do make loans, we have what we call the money multiplier effect. So if a bank has, say, $1,000 in excess reserves and decides to lend them out to someone else, right? That person now, the bank sort of creates an account for that person, and that person has $1,000 that they can go out and use for whatever purposes they want. When that person spends that $1,000 lands in the hand of someone else. Perhaps they're using it for home improvement and it ends up at Lowe's or Home Depot. They get that $1,000. They take that, deposit it in their bank. Their bank now has an additional $1,000, but their bank also has to hold, let's say, 10% against that. So they keep $100, right, against that. The subsequent $900, the $900 that's left, they can then lend out to other people. Suppose they do. The next person has $900. They spend it. It goes to their bank. They keep 10%. That's $90. They can lend out $810, so on and so on. You can go through this whole process, and the book sort of lays it out. And if you add that all up, what you're going to discover is that the banking system as a whole can create a multiple of that original loan. So the original loan was for $1,000. What we know is that the banking system can create 1 over the reserve ratio times that original 1,000. So 1 over the reserve ratio, if the reserve ratio is 0.1, 10%, 1 over that is 10. So 10 times the original $1,000 loan means that the banking system as a whole can, at least at maximum, create $10,000 worth of money out of that original $1,000 loan, that $1,000 deposit that made that loan possible. So anytime new funds come into the banking system, anytime you pull, say, money out from under your mattress, or the Federal Reserve creates new money, as we'll talk about shortly, right, that can set off this money multiplier process. If the Fed creates $1,000 of new money, it winds up in the bank, they lend it out, we get the process we just described. Notice, however, if I write a check to you, right, and you deposit it at your bank has new money. They can, if I wrote a $1,000 check, they could start this process at your bank. But notice, right, it's got to come out of my bank. So whatever happening in your bank is being canceled out by the negatives in my bank. So writing a check from one person to another can't make a net addition to the money supply. What makes net additions to the money supply is when we get influxes of the monetary base. One way that can happen is you pull cash from under your mattress and deposit it. But the most common way is that the Federal Reserve injects new reserves, creates new reserves out of nothing, begins the process, therefore, of the loan and of the money multiplier, and so on. Which leads naturally to the question of, how does the Fed, in fact, control the money supply? And it's really got 2 broad tools at its disposal these days. The first is what we call open market operations. The second is interest on reserves. Open market operations has been the Fed's major tool for decades. Okay, and what open market operations refers to is the Fed buying and selling short-term government bonds in order to affect the level of reserves and hopefully affect the level of economic activity taking place, the level of loans and so on. So if you think about it, right, when the Fed buys government bonds, what happens? How does it do this, right? Well, simple answer is it pays for those bonds by writing a check off itself, basically creating the money out of nowhere. So if it buys the bonds directly from a bank, it just credits the bank's account at the Fed. If it buys the bonds from Goldman Sachs or something like that, right, it credits Goldman Sachs, it indicates to Goldman Sachs Bank that those have been bought, and it credits it tells Goldman Sachs Bank what's happened. Goldman Sachs Bank then gets a deposit in its account at the Fed, and Goldman Sachs sees its deposits at the bank increase as well. So when the Fed buys bonds this way, right, it is injecting funds into the banking system, right? So it does so by paying for those bonds, by creating new reserves. And sort of how does that affect the macroeconomy? Well, two ways. When the Fed buys bonds, it pushes up the price of those bonds and it pushes down the interest rate on those bonds. As the interest rate on those bonds fall, borrowing's cheaper, investing, the ability for firms to borrow money for investment is cheaper, more economic activity will take place. Plus, as we've said before, there's an addition to the money supply this way, right? There's more money out there to be spent. So either of these channels, right, either through the interest rate lowering and that spurring spending and investment, or through the direct path of the money supply. So when the Fed buys bonds, bond prices go up, interest rates fall, expansion takes place. This all works in reverse when the Fed sells bonds. If the Fed sells bonds, right, money comes out of the banking system, money comes out of reserve accounts. Banks have to shrink the amount they lend. The prices of bonds fall, interest rates rise, lending slows down, economic activity slows down. So that's open market operations, is the buying and selling of government bonds. The hope is to influence the level of reserves and interest rates. The other main tool that the Fed has these days is paying interest on reserves. Now, this wasn't a tool until the financial crisis in 2007, 2008. And the way it works is the Fed pays a very small amount of interest on the reserves that banks hold. And part of the reason for this was that during the crisis, the Fed wanted to inject a whole bunch of reserves into the banking system. One, to make sure banks were sufficiently liquid if people came and wanted to withdraw their money. But also, it was part of the Fed's process of buying up the junky mortgages and other securities that were on the balance sheets of various banks. If the Fed had done that and just sort of thrown all those reserves in there, the risk would have been banks would have had all these reserves. They would have lent them out. We might have had massive inflation. So one way to guard against that inflation was to pay interest on those reserves and give the banks an incentive to keep them, to sit on them. And that's worked well, perhaps some would argue too well. As interest rates in the economy have gone down near zero in general, that small interest rate that banks earn on those reserves is a pretty good deal, and banks like it because it's certain, right? They know they're going to get that quarter point or that half point or whatever it might be. And what the Fed can do is adjust the incentives facing banks by adjusting that interest rate. If the Fed wants contractionary policy, if it wants the banks to sit on those reserves and not lend them out, it can raise the interest it pays on reserves. That gives the banks less incentive to lend them, more incentive to hold them. If the Fed wants to encourage banks to lend, it can lower the interest rate it pays on those reserves. As it does, banks would be more likely to search for higher rates of return, risk-adjusted rates of return by lending out in the marketplace. So that's the trade-off here, right? And what the Fed is hoping to do, right, is to use that interest on reserves as a way to sort of tinker with the demand for reserves by banks, and therefore to tinker with the total amount of reserves that are being lent out at any time. So those are the two key tools the Fed has. It can conduct open market operations. It can change the interest rate on reserves. And what's the hope here? Well, the hope is that the Fed will use these tools to influence money supply and spending, to influence the aggregate demand curve, right? That's what we want to see. Ultimately, if the Fed's trying to, say, increase aggregate demand and increase output, it can buy bonds in an open market operation, as we've talked about. It can lower interest rates on reserves and encourage banks to lend, right? There's all kinds of things that it can do. All of those things, it hopes anyway, will increase aggregate demand. And you can sort of see, if you have the slides in front of you, you can look at slide 63 that shows the sort of basic story that we've talked about already in previous chapters. The problem is that this is very tricky for the Fed to do, and this is what we'll really talk about in the later chapter in 16 when we talk about policymaking. But here's some of the questions the Fed has to try to predict and answer to sort of know just how much the policy change it's going to make. If it buys a certain amount of bonds or changes interest rates a certain amount, what will happen to the aggregate demand curve? One question is, will the banks lend out all the new reserves it creates or only a portion? Right? You can change the incentives facing banks, but you can't force them to lend. How quickly do these changes in the monetary base become new bank loans, right? There's the danger of of long and variable lags, right? Of taking so much time for the new money to get to the system that by the time it gets into the system, the problem it was hoping to solve has already been solved. Other question is, do businesses want to borrow, right? Even if banks have the funds, are businesses interested? Are they optimistic? Do they think it's worth it? Are they worried about policy? How confident are business people? And finally, when businesses do borrow, what are they going to do with the funds? Are they looking to just hold that money as sort of a liquid asset, or are they actually going to engage in some kind of production, hire capital, and hire labor? All of these are the questions that the Fed has to answer that it doesn't know the answer to with certainty when it begins to conduct policy. And as we'll see again in a couple weeks in Chapter 16, this poses major problems for how the Federal Reserve and how monetary policymakers in general translate these tools that they have, things like open market operations and interest on reserves, into actual impact on aggregate demand in the macroeconomy, because that's what they're really after. That's what they want to be able to do. And the question is, how effective can they really be at doing it, given the tools that they have and given these questions and uncertainties? And as we'll see next week as we detour to Chapter 21, also given the incentives facing political actors, how does that affect their ability to conduct policy? So that's where we're headed, and that's the story for monetary policy. I'll come back as part of this week's work with a short discussion of fiscal policy in Chapter 17 next.